Hello and welcome to Portfolio Matters Week 16 Weekly Update. But before we get into it, Richard will read the disclaimer.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. So Keith, what are we talking about this week?
Okay, so first of all, news. Well, events of this week were not much really. There was an ECB meeting where they decided not to change policy and to continue with the bond repurchase program in its current size. And recently, the bond repurchase program has been growing. So in March, they purchased 74 billion euros worth of bonds, which was higher than either March or February. And really this month, they were in a holding pattern. And it is next month that people are talking about the ECB may have to make a decision. At some stage, they're going to have to curtail the bond purchase program because people will start to be worried about inflation, but that's not yet.
So this is the ECB balance sheet, which, as we can see, is continuing to rise very steeply, as you'd expect from what Keith has just told us. And the question is, at what point does the system become unstable because they have bought so many European debt, so much European debt. So I picked this up. I think we all picked it up, didn't we, Keith? Biden has told this climate summit that the US will cut carbon emissions by 50% below 2005 levels by the year 2030, which I don't know what the exact sort of maths of this is, but it must be quite an enormous cut that he is proposing. And it has to be done via nuclear and via renewables. And this is going to be another huge demand on those commodities that we've discussed many times.
Absolutely. If they follow through with this, that means huge investments in electric vehicles, for instance, and cobalt, lithium, copper, graphite, they go through the roof.
I read today that one of the European car manufacturers, I can't remember which one, is saying that the European Commission is obsessed with battery-operated vehicles and it isn't considering other clean alternatives such as synthetic fuel and hydrogen. And of course, this is the problem where you have bureaucrats deciding what the technology of the future should be. And we have rather, I suspect, got ourselves into that situation. And it just puts extreme pressure on battery metals and materials.
Actually, synthetic fuel is interesting. You can actually make long-chain hydrocarbons from carbon dioxide. At the cost of a barrel of synthetic fuel is around $200. So about, at least 3 times the price of a barrel of oil.
Well,
so
it's interesting
at some stage.
Yeah, it's interesting that it can be done. Presumably, if you have enough nuclear power, you can do it all day long and you don't mind.
Well, absolutely. Okay, now this week, what we thought we'd do is step back and take a look at the macro picture as we see it. So each week we look at a lot of graphs, and it's quite easy to get lost in the minutiae and lose focus on where we are now. So where I think we are is that over the last 5 weeks, bond yields have stabilized. In fact, they've dropped slightly. And that implies that the bond market thinks that inflation expectations are well anchored, and also that they don't believe that there will be a sustained rise in inflation. It's noticeable that bond yields have really not risen that far at all. They're only back to where they were pre-COVID. So despite all the money printing and fiscal that has gone on over the past year, we're only really expecting the bond market, if it is to believe, is only really expecting the same level of inflation as at the start of 2020.
this is the great conundrum, I think, Keith, isn't it? Is the bond market now reacting to what it expects the central bank to do in terms of yield curve control, rather than to what it thinks economy and inflation rates are going to do? But as we discuss later, there is a lot of price increases in commodities, and it is obvious that inflation is at least temporarily going to go up significantly. And if bond yields aren't suggesting that that's the case, then maybe they believe that the central bank is going to continue buying bonds. And I mean, the other issue that arises is that if all central banks are doing it, then the currency devaluation doesn't matter, because all currencies devalue at a similar rate. But of course, you do get inflation, but you have inflation while your currency is maintaining its level in comparison with competitors.
Well, the other thing I would say about bond yields, Richard, is that all the central banks of the world are doing their damnedest to manipulate bond yields through quantitative easing. And so extrapolating any wider macroeconomic readings from the bond yields can be misleading.
I think you can't do it, Keith. I think you have to acknowledge that the bond yield is no longer a true indicator of where investors generally think the economy is going. Yeah.
Because there is a big gap between what bond yields are telling us and what equity and in particular commodity prices are telling us. And spot commodity prices are an indicator of what is happening right now. And what they are saying is there's very strong demand. And equity markets are pricing in a very strong recovery and strong earnings growth. Now, there is a contradiction here in that we are seeing very strong input price inflation, both labor price inflation and commodity price inflation, but equity markets are expecting high earnings growth, which implies no loss of margins. Now, some of the charts we're going to take you through today show very strong inflation. In fact, in the case of, say, lumber prices in America, astonishingly high inflation. And the equity market...
Sorry, I was just going to say, we also have the interesting situation, for example, with motor vehicles, where motor vehicle production is being significantly curtailed by the lack of computer chips. And that will inevitably cause significant increases in prices of not only new cars, but also knock-on effects on second-hand cars. And so it's now motor vehicles, there may be an incremental profit effect for the manufacturers of motor vehicles, but the consequent effect is a large hit in terms of the prices that people experience, brought about by a shortage, brought about by supply chain problems. And I'm not sure where these supply chain problems have come from.
Well, the supply chain problems are in part because everyone is spending money on manufactured goods because they can't spend it on services. So therefore you have it's been surprised we've got inventory problems, but also there's a shortage of shipping, as we have covered elsewhere. But I mean, my point is that if companies can pass on these costs, then you have inflation, and you have potentially very high and inflation that sets off an inflationary spiral, because you then, if goods price inflation rises, then it cuts into people's earnings and they start to demand higher wages, etc. At that point, the central banks have to step in and raise interest rates.
The danger we have is that the central banks, I think, have been incredibly naive in thinking that they can turn the inflation dial up and down by 1 or 2 percentage points without any problem, and flies in the face of the experience of the 1970s, where inflation was totally out of control. And we've got this bizarre situation where the central banks are actively talking down inflation, actively wanting inflation because it's the only way of getting rid of these huge volumes of debt that we have, and actively unable to raise interest rates, because if they do, they bankrupt the debtors.
Yeah, absolutely. But so which brings me on to my main point, that at some stage in the next year, I think central banks will face a crucial question. As inflation rises, do they say that it's temporary and just let it go? Or do they actually try and enforce their mandate and raise interest rates? And what they do will decide what our optimum asset allocation is. Because if they let inflation rip, you want to go into assets which protect you against inflation.
So my view there, Keith, is that they have no option but to let inflation run. They will let it run because it's what they want, although they won't really admit it. And when they realise that they can't control it, it will be too late. So my view is you have to position yourself now for inflation, and that by the time central banks realise they've got to do something about it, those assets that you should have bought will have been elevated in price to the point where they no longer be the sort of the protection that you would require. My view is you have to move now.
Right.
I also think that central banks can't raise interest rates significantly. They're going to have to keep interest rates below the rate of inflation. Otherwise, they will simply bankrupt the system, and they can't do that.
Well, I largely agree with you, Richard. The only thing is, I think that I don't think you should bet the farm now. You should wait and see how things develop, and then be prepared to be nimble.
Sorry, Keith, I agree. I think you're right. But what you can do is you can pick commodities that are almost certain to go up, whatever happens. Battery metal, for example, and copper. And there's two impetuses behind them. Obviously, there's the greening of the economy, and there's potential and fugitive inflation. So I think that those are the assets you have to go for as your inflation protection.
No, I agree with that.
So I thought I'd have a look through yesterday's Financial Times, Keith, and I just pulled out some headlines that I think are quite sort of instructive in terms of what's going on in the world, big picture-wise. So Draghi piloting 221 billion euro rebuilding of Italy's recession-ravaged economy. No mention of the fact that it's also debt-ravaged. And 221 billion, another, it's like debt. There is no problem with debt, or there is a problem with debt. The UK business failure fears rise as help eases. And the little note on the top left-hand corner, a zombie warning. Have we got a lot of zombie companies? Charities begin to feel the squeeze as rising demand meets falling income. Dulux own awards of higher paint prices. And this is one that really rankles with me. Central banks must act now on climate change. I mean, central banks have been a disaster in terms of managing debt, and we want them to act on climate change. Where is their remit for that? What is going on in the world that the central banks are now the driver of movement on climate change? That's a political subject. I was appalled when I saw that.
Yeah, well, on that case, I absolutely agree with you. Okay, so also, where are we on COVID, Richard?
Thanks, Keith. So I just pulled off a few graphs that I think are quite interesting. And so the first graph shows the vaccine, which is really interesting. United Kingdom, United States, way ahead of the rest of the world in terms of the number administered per 100 people. Europe is doing a sort of slow catch up. China, the rest of the world, Asia and India, very low. And as we know, in India and South America, other places around the world, there is a serious COVID crisis still ongoing, and in some cases, getting worse, not better. So I suspect we are going to exit this pandemic in 2 or 3 halves, i.e. there will be the winners, people who come out first, and there'll be a lot of countries that take a long time to get out of it and maybe haven't gone through the worst yet. So we're not going to come out as a unified world. So the reproductive rate in India, estimated to be around about 1.5, which is really, really problematic. Yeah. And only in the major countries here, United Kingdom, United States, less than 1, presumably because of the vaccination program.
Can I just add that I don't believe the Chinese numbers?
Yes.
Because they don't add up. They don't make any sense at all.
No. an R of greater than 1, but hardly any cases. This is
Yeah.
interesting just because it's number of tests. We conduct far more tests than any other country in the world, which is great, and that's why we've been so far ahead in terms of identifying variants. And but what's fascinating about this, I think, is you look at India. So you have to ask the question: how many cases have they really got? Because they're conducting so few tests.
Good point.
You know?
Yes, good point.
And then this is just really sad. This is this is from the Financial Times, and it's what's happening for cases of deaths in India, and you know, they have completely lost control of it, and it's very, very sad.
Yeah. Okay, so now on to our weekly charts, and we're going to start off with a chart from last week, which showed that S&P 500 companies in the US were increasingly mentioning inflation, and in particular, they were mentioning labor price inflation. And we now have an explanation as to why they were mentioning labor price inflation, because if you remember our commentary of last week, I was puzzled by the fact that companies were talking about tight labor markets when unemployment was so high. But then our listener in the US, Herman, provided us with this advert from the San Antonio News, which showed an advert just for the local barbecue place where they were offering now $15 an hour plus $100 retention bonus and then $300 referral bonus. And he went on to explain that what is happening is that Biden has set the COVID additional unemployment relief at a level of around $15 an hour, which is more than most low-paid workers normally get. And he believed that this was an intentional policy to try and raise low-paid workers' wages now and going forward. And this policy stays in place until the 6th of September. So if you're a low-paid worker who has historically earned, say, $12 an hour, then you have no reason to go to work because you can continue to stay at home and get $15. So employers have had to try and raise their wages to attract workers. And if we move on to the next chart, which is from CNBC and the US Department of Labor, it shows how unemployment benefits relate to normal hourly wages for low-paid workers. And you can see in the vast majority of states, the benefits you get as part of the COVID relief package are higher than wages. So in all these states,
it's interesting, Pete. It's interesting. So do you remember Russell Napier, who appears on various webcasts from time to time? One of the things he was saying a few months about inflation was he didn't think it was going to be a problem until government started printing money and putting it into people's bank accounts.
Yeah.
And this is exactly what's happening.
Absolutely. So frankly, I see inflation absolutely everywhere at the moment. Moving on. So US retail sales are incredible. You know, you put a load of money into people's pockets. Of course, they're spending it. On the flip side, though, we do have evidence that China is slowing down. So that China's got the lowest quarter-on-quarter growth in a while. And frankly, I also don't believe the Chinese COVID numbers. So everywhere in India, there's a resurgence. Chinese have not done very well at vaccination. Could the two be related? We don't know. Chinese credit growth is decelerating. So that's something to watch.
We also know the Chinese are tightening up considerably on companies that are over indebted, and they're not bailing them out, and they're forcing them to pay back their debt. And I think the Chinese are probably quite concerned about the level of debt in their economy. This would be a balance sheet recession, wouldn't it, Keith?
Yes, that's right, because they're unable to take on more debt and therefore they're unable to invest.
Yeah.
Good spot, Richard.
Thank you, Keith.
So this is car rental price. Sorry. Oh, this is car rental prices in the US, because Richard also talked about used car prices, which have also gone through the roof. So everywhere I see inflation. US manufacturers are reporting a big order backlog. So that is great. That means that they have work ahead of them for the next months. So they try and fill that.
It also means they can, it also means they can put their prices up without having to worry about not being able to meet, losing demand.
Yes, good point. Very good point. Okay, so onto the weekly checklist. Equity markets. The UK resumed its underperformance. So all shares down 1.3%. The S&P 500 was flat. The NASDAQ was down slightly. Topix was down 2.4%. Bitcoin had a bad week, and I'll leave Richard to talk about that when he does his weekly activity. Sterling had a decent week, up 0.6%. Now, this chart, beware, this is rolling 23-week periods, which exaggerates the effect, but it does show absolutely enormous inflows into equity funds, presumably in part because of all the stimulus checks. So that is one reason that the US in particular has been doing so well. Okay, moving on to industrial commodities, and they have just no signs of coming back down, most of them. Aluminium up 2%, cobalt flat, copper up another 3%. Iron ore up 5.7%, and that has defied all my expectations that it would come back down again. Lithium is quite an illiquid market, and that was flat during the week. Neodymium is also an illiquid market, so both lithium and neodymium, I'd be quite wary about reading too much into any 1 week's change. Nickel is flat. Ferrovanadium also flat. WTI had a volatile week, and I will be including quite a few charts on the oil market, but that was down 2.7% this week, and inventories are building. Uranium is drifting off. So when we talk, let's talk about some other commodities, and this is the price of US lumber futures, and it's absolutely astonishing. It has quadrupled in a year as house building gets going. You know, that is a big pot. So US homes are mainly made out of wood, and that is a huge input price. So inflation is coming. Now moving on to oil. So this is from Art Berman, a US oil analyst that I really like, and he is expecting the oil market to actually move into surplus in Q2. And that is not good for the oil price, which won't be good for my personal portfolio. But then later in the year to move into deficit. Remember,
is he expecting any particular price moves, Keith? Because I think he's been quite accurate in recent past, hasn't he?
He had. I think he's quite wary of predicting the price, actually, Richard. He's very skeptical that the price will rise too much in the near term. But remember that OPEC currently have at least 6 million barrels in their pocket. So they're in control of this market. If they were to decide to turn the taps on, I think we'd be back at $40 a barrel pretty quickly. So now I had been puzzled why the oil majors like BP and Shell have performed so badly this year compared to the oil price. If you remember a chart we did either last week or the week before, it showed how oil prices were back up to where they were at the start of 2020, but the majors were down by 40%. And this explains part of it. This is the Brent futures curve. And what it is showing is that we are back in backwardation. So the price forward, and these are months, so the price 4 years hence is what, $57, which is substantially below where we are now. So the market does not believe that the current high oil prices can be sustained. And this is a chart showing the output of OPEC. And you can see here that there is, according to this, there's probably about 6 million barrels of spare capacity.
Yeah.
Okay, and uranium. Richard, do you want to talk about uranium?
Well, I don't understand uranium, Keith, to be honest. I think the logic for the demand for uranium going up substantially is impeccable, yet the price isn't moving. So I'm a bit flummoxed by this, and I know you're much more cynical than I am. You're saying, well, look at the facts, and you have a point. I think that it may be that there is in fact sufficient supply, but there are a lot of people around who've researched it much greater extent than ever I have, who say that demand is going to exceed supply. So maybe the question is just hanging on and waiting. Well,
I agree. I really like the story, Richard. The trouble is, I've been hearing it too often for too long, and I don't know. Whenever riding on this, I think is the answer. Don't have too much riding. I have some uranium investment, not a huge amount, and I think it's important to keep it relatively small because you want to sit here for 5 years watching it go nowhere. Yeah, or another 5 years. Okay, and as we talked about, iron ore. I mean, really strong charts. A very good. If I was a technical analyst, Richard, and I ain't, I'd say this looks pretty attractive chart, frankly.
I think you're right, Keith.
Copper looks even better. I mean, that is just a straight line.
It's a straight line, isn't it? Yeah. There's a nice bull flag there, Keith. The last
really?
Months. Yeah.
Oh, you'll have to draw these on next time.
Okay.
Now they're moving on to commodities we don't normally cover, but I was very taken by some charts from the UN Food and Agriculture Organization this week, which showed rapidly rising food prices. Now, if you remember, the Arab Spring in 2011 was partly caused by rising food prices. Around 40% of Egyptians apparently live below the poverty line, and they spend something like 20% of their income on bread. So when the bread price rises, this causes substantial hardship. And watch this space. So this is their index, the UN's index of food prices, and you can see it picking up. That is 2021 and rising. It rose throughout 2020 as well. So you're now looking at 20% above 2015 levels. Yeah. And then if we go to agricultural spot index, shot up. Corn, look at that. These are futures prices. That has doubled in 6 months. Soybeans doubled in 6 months. Oats up only about 50%, 60%. My God, it's underperforming.
They laggard.
Exactly. And how quickly does let's say the corn price affect your bowl of cornflakes in the morning?
Probably quite quickly, I'd say.
Yeah. So all of these seem to tell me inflation is coming.
Yeah.
Okay, moving on to precious metals. Good week. Gold was up 0.7%. Silver was flat. Platinum also up 0.75%. Rhodium stays strong, up 1.4%. Palladium is up 3.9%. And last week we commented on how we like the look of the palladium chart, and it's kept on going up.
Yeah.
Now, in other matters, China has opened its borders to gold imports, so Chinese people can now buy physical gold again. That has to be good for the gold price, I would have thought. Balance. Palladium chart looks good. Rhodium, still looks good. And finally, rates. So, as we talked about earlier, last 5 weeks, rates have been quiescent. So the yields on UK bonds fell throughout the week. So bond prices rose. And I just don't understand it when I see all these prices of input prices rising and bond prices are falling. I just think, what are they smoking? It's only a question of time before you see inflation. However, the March UK inflation numbers are out and there's a pickup, but it ain't big. March RPI 1.5%, CPI 0.7%. But I think later in the year, you're going to see some big numbers. And this is the UK 30-year. Not much going on, down on the week. US Treasury. Now, I've taken the long-term graph of this because you see that in any up and down pattern, you obviously get some volatility. And I just think this is a pause and then we go up. But
I think
right now,
I think it's a pause and then we go down, Keith. I think the trend continues and it heads back down to a new lower low below 0.5 or whatever it was there.
Yeah. How? So they have to buy the entire output.
Central bank intervention.
Yeah, well, okay.
We'll see.
And this is this seasonal chart, which has been doing an amazingly good job this year. So last week was great, and this week has been kind of indifferent. But next week is going to be kind of indifferent. Yeah, and then May's going to be great.
Makes you wonder why sell in May and go away.
Well, yeah, well, you should sell in May and go away. End of May.
Sell at the end of May. I see, yes. Sell at
end of May. Exactly. So we should give up this job, Rich, and just use this chart.
We should.
Now, before we move on to our portfolio, our individual portfolio activity, I wanted to ask a question. So we would like to be able to communicate with our subscribers outside of just posting videos. In particular, as lockdown eases and Richard and I start to have lives again, or I in particular start to have a life again, we will, our schedule would become more unpredictable. And so we'd like to be able to say, well, this week's weekly will go out on, say, Saturday morning or Saturday night or Sunday morning, etc., rather than Friday. And we'd like to be able to tell people that. If you have any suggestions how we can do that, because frankly, I don't think a Twitter feed will really work very well. Tweets just fly by your account and they're quite difficult to see. We need a kind of a bulletin board. If anyone has any ideas, please let us know. Richard, what has been your weekly activity?
Thank you, Keith. So this week, my portfolio was very slightly down. No purchases, no sales, a distinct lack of activity, which is frankly how I like it. Makes me feel calmer. Keith mentioned Bitcoin. So as we saw Bitcoin, I think the news from Turkey that Turkey is banning the use of Bitcoin, which they can't really do, but I think that was a dent to it. I think the comments by Biden about doubling capital gains tax have been mooted as having an effect on the Bitcoin price, and various investigations for money laundering, I think, have also had an impact on the Bitcoin price. I mean, I think probably what you could say is holders are particularly nervous that it might have reached a peak, and they're very twitchy, and the thing is extraordinarily volatile, up and down 5 or 10% in a day. But interestingly, it's just come back to its 100-day moving average. So it hasn't done anything particularly extraordinary in that sense, but nevertheless, it is if you had a big position, it would be a real white knuckle ride. I have a small position, and I'm watching it with interest, really. And Ethereum has been very volatile, but it hasn't moved as much as Bitcoin has. And I think I read something, I think this morning actually, where someone was promulgating that Ethereum may become more important than Bitcoin in terms of running the disintermediated financial system. And we shall see. But it hasn't been as volatile and hasn't fallen as much as Bitcoin, interestingly. Shit's put has done really badly. It's dropped 40%. So basically, you don't want to be in too many of these unpleasant coins. It's really not a good performance, is it? We'll keep you posted on this one, and it's there for a bit of fun, really. Gold.
Yes,
I put this.
great.
Gold. Sorry, Keith.
No, great. I like that chart.
I put this chart of gold in because people are saying gold has broken out of its very long flag, and it may have, or it may come back down into it. We don't know, but it is clearly peeking out of the top trend line here, which may be good news for gold. And that's what I wanted to say, Keith.
Thank you, Richard. Actually, before I get going, a quick comment on gold. I'd say I'd be wary of believing too much of a breakout in gold, in that I noticed that the uptick in gold has been simultaneous with the fall in bond yields, which I don't believe is sustainable. And I'd like to see gold do well when bond yields begin rising again before I would make too much of a bet on gold. Anyway, my weekly performance has again been pretty poor, frankly. And once again, the culprit is oil, which I own a lot of. And we've already covered this, but Art Berman is forecasting a difficult quarter for me, but then hopefully clear blue waters later in the year. And I follow the oil cycle, and I believe that going forward, it is a strong bet, a rising oil price. But anyway, this week I was down 2.2%, which takes me to just up 3.8% on the year, which means I'm heavily underperforming the all share, which is disappointing. Now, during the week, I sold a bit of platinum because I needed some cash, and I bought some. So last week we did a share talk on Techmar, and the more I analyzed it, the more I thought, actually, I don't take enough big positions in the stocks I like, and I like Techmar. So I bought some more Techmar, and I bought some more Capital, which I also like, and is again, we did an early share talk on, and I'd urge people to see it if they haven't. Luke Oldfield, who does our small cap discoveries, was talking to me about a tiny oil company called Advanced Energy. So I had a quick look, and I quite like it. So I bought a very small position. And finally, Petrometad started to move. So I topped up. It did. And actually, let's talk about Petrometad. So this is Petrometad. This is the share price, and you can see we talked about it about here, 3 pence a share, and this week it shot up. Now, what is noticeable is we haven't actually had the good news yet. People are just anticipating the good news. But the thing is, we've seen this kind of pattern so many times where you think something is undervalued and it just needs a catalyst to get the share price going. And when people anticipate the catalyst going, it suddenly moves, and it moves too quickly for you actually really to get a position on.
Yeah.
So what you were talking about before, Richard, about, positioning yourself before inflation gets going, sometimes the markets move so quickly that you can't actually wait for things to happen. You have to be in anticipation. And finally, Rambler Metals continues to steadily drift up, and it's had another good week. And if you've watched our share talk on Rambler Metals, then you'll know why. And the shares, I think, remain seriously undervalued if the turnaround plan can be executed. And we hopefully will get a bit of news on that soon.
Good. Thank you.
And I think that's it.
Thank you very much for that. Very interesting. We'll all be running off to have a look at advanced oil?
Yeah, well, I think it's Advanced Energy. It's it has an idea I think it's got an asset in Timor-Leste. Actually, what is really interesting about Advanced Energy is that it's going to specialize in old fields. So
Luke likes it then.
yeah, so I think that's quite an interesting business model, actually. Finding fields which around the world where production was cut short because of various problems, and new technology and higher oil price means that actually you can reactivate them. So there's no exploration, risk. You know the oil's there.
Just getting it out risk. Good.
Absolutely. So anyway, thank you all for watching. Please can you press like and subscribe to the channel. And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.